Talking about ETPs, right?
Yeah.
Why do institutional allocators continue to favor ETPs over direct crypto holdings, and which regulatory, custodial, economic, and operational considerations carry the most weight in that decision today?
Okay. That's actually a great question. And um, the answer comes down to ease. Now, today it's gotten easier to purchase digital assets. We have wonderful companies like Coinbase, like crypto.com, Binance, the list goes on, where you can set up an account and buy the digital assets. But that said, setting up an account and buying the digital assets is still a relatively new process, and finding out which assets to choose, how to store them if you decide to move them from the um, uh, custodial account platform to a non-custodial account platform is a challenge. Now, for our viewers and listeners, a custodial account in the world of decentralized finance are a set of wallets that are held and controlled on your behalf. A non custodial account is a platform that would enable you to connect a wallet for which you hold and own the keys directly yourself. Now, whenever you're dealing in the world of brokers and dealers and traditional brokerage accounts, this world has been established for well over 100 years. So the laws, the means of holding these assets has been so well established that it is easy for people to invest. It's easier for portfolio managers to manage assets on behalf of the clients. And most importantly, it's easy for accounting, taxation, reporting, and trust and estate planning purposes. Whenever you're dealing with specific wallets on specific chains, and if you're buying particularly from a decentralized exchange as opposed to a centralized exchange, there are a number of variables that come into play. You have to figure out how you manage the wallet and the wallet keys, and understand that many of those wallets, in the case of some chains, are actual nodes. So that means when you download the wallet, sometimes you have to download an entire copy of the blockchain onto your system. So there are some chains where when you go to just check your balance, it's almost frightening if you haven't opened that wallet in a lot of time, because it can take days to download a copy of the chain in order for you to have a current record of your balance. And that's one chain. Now, if you want to be exposed to the broad array of tokens for in order to be able to execute a particular business strategy, imagine having to run wallets on all of these particular specific tokens and being able to manage them. That means including updates, and they update often because they have security patches and everything of the sort. This means you almost have to become somewhat of a Web3 DevOps engineer just to hold the assets. And even then, how often have we heard of potential security lapses and whatnot that have resulted in loss? So, this is where the exchange traded product comes into play. Via the exchange traded product, there is an extensive multi year regulatory process for ensuring that investors gain access to the underlying asset, but they also get effectively a second tier of protection because their holdings are oftentimes guaranteed by the balance sheet of the underlying company.
Mhm.
On top of that, every regulator goes through and makes sure there are adequate security protocols, there's adequate investment protocols, there's adequate pricing protocols, market making protocols, and liquidity for each instrument. So, what does this all mean? It all means that via an exchange traded product, you gain access to the value or the actual assets of the underlying ETP, but you don't have to deal with a lot of the technical uncertainty associated with custody, yield, staking, wallets, keys, which make it otherwise unwieldy. But from a broader perspective, because I know, I come from the Web3 world, so I know a lot of people, they'll say, oh, well, not your keys, not your tokens. But from a broader perspective, the law has more oversight over what is happening with an ETF and ETP issuer than over somebody who may issue a token on a specific chain and then basically liquidate a lot of the issuing position so that you're held with something that has little to no value in the end. So on the other side of it, there is additional value whenever it comes to liquidity, because what is happening is the regulators are very keen to ensure that there is an efficient market. So you tend to have clarity of pricing, clarity of fees. So if the prospectus of the digital asset ETP that you purchase has a fee schedule of 1.9%, you know you're not going to be paying anything more than that for having access to secure access of the token, ensuring that the token that you're buying is the actual token. So there's no chance that you're going to be buying a BTC token that somebody else minted on another chain, used that ticker symbol, and then you think you're buying Bitcoin when in all reality you're buying nothing. So there are so many of these sorts of scams, but in the case of investing via an ETF or an ETP, you have an ISIN number. It is regulated, oftentimes by multiple regulators by law. It is double protected by the underlying company, the issuing company's balance sheet. You have audited statements to ensure that the issuing company is doing what they're supposed to do, and you have a high level of assurance, almost 100%, that the issuing company is actually selling the underlying token that they say that they're selling. On the other side of it, once again, another very important consideration is estate planning. So if I have purchased a lot of token and I have access to the keys and I've memorized the keys, or I've put the keys, I've written it and I've tucked it in a jar someplace in my house, and I happen to get hit by a bus, that wallet may end up holding that crypto forever. And my relatives, my family, children, anything like that will not be able to gain access to it, even if the courts say you're entitled to those assets. But whenever you are purchasing through a standard brokerage account, estate planning is facilitated because they're using traditional finance rails. So there's a lot of ways in which the modern move towards exchange traded products facilitates the movement of capital into the digital asset market space, out of the digital asset market space, and enables more individuals, retail, and institutional investors to participate.